Right now, the UK government is they're spending more money just paying the interest on their national debt than they spend on their entire defense budget.
Yeah, it's wild.
It is. And meanwhile, gold is touching $5,000 an ounce. Wall Street titans like Blackstone and Morgan Stanley are literally locking up their investors' money.
Right.
And over in Qatar, the world's largest liquefied natural gas facility is actually burning.
Literally on fire, yeah.
Exactly. And I think if you just scan the headlines lately, it is so easy to just treat all of this as like background noise.
Just another bad day in the news.
Right. It feels like a stream of bad luck, just isolated, chaotic events happening out there in the ether.
It definitely reads like a laundry list of global misfortune. I mean, if you're just casually scrolling. But when you pull back and actually map out the mechanisms connecting these events.
Which is exactly what we're doing today.
Right. You realize it is anything but random. These aren't separate stories. They are, one single massive story reacting in real time.
And that's our mission for this deep dive into the convergence essays. We are stripping away the noise to show you how these events are intimately connected.
Because they really are.
They are. We're looking at this profound structural shift. It's the intersection of a failing fiat monetary order, a physical energy crisis, and the exponential explosion of AI.
Yeah, the AI piece is huge.
And we're going to prove to you that these aren't just random headlines. They are the creaking sounds of a financial bridge that has just carried too much weight for far too long.
Well, to really wrap our heads around how fragile the system has become, I think we need a mental model.
Okay, let's hear it.
Let's imagine a town that kept building houses on a floodplain.
Right.
Everyone living there knew the historical risk of floods. But, developers kept building anyway because the money was good.
Sure.
And every time a massive storm hit and the waters rose, instead of moving the town to higher ground, the local government just built a bigger dam upstream.
Oh, I love this analogy. So they built one for the dot-com bust in 2000. They built a massive, unprecedented dam for the 2008 financial crisis. Then they built emergency dams in 2020 for COVID, and then another set of reinforcements in 2023 when the regional banks started failing.
And every single time, the dam held.
Right.
But every single time, it was built further and further upstream, which basically allowed an even larger, more complex, heavily leveraged town to sprawl out below it.
Just asking for trouble.
Exactly. So we are now at a point where the entire global economy is sitting at the bottom of a very steep valley, just looking up at the ultimate dam.
So the terrifying question we have to explore for you today is, are we looking at the storm that finally crests that ultimate dam?
And to answer that, we have to examine the concrete that dam is actually made of.
Okay. What's the concrete?
That concrete is the government bond market.
Right.
For most of modern history, certainly since the U.S. dollar was taken off the gold standard in 1971, which, birthed our modern fiat system.
Where money isn't backed by physical commodities?
Exactly. Since then, sovereign debt has been the foundation of global finance. Things like U.S. treasuries or U.K. gilts.
Just to be incredibly clear on terms for everyone, a gilt is just the UK government's version of a treasury bond.
It's an IOU.
Yeah, an IOU. You lend the government money, and they promise to pay you back with interest. And the whole financial world treats these IOUs as the ultimate, pristine, risk-free asset.
Right, not stocks, not real estate, government bonds. That is the bedrock assumption of the entire global financial architecture.
Wow.
The whole system only works if that debt is universally perceived as stable.
But it's not stable anymore.
No. The underlying math of that concrete has quietly degraded. The debt has simply grown faster than the real economy can support.
Give me the numbers.
Let's look at the UK as a prime example. Public sector net debt is currently sitting at roughly £2.88 trillion.
Unbelievable.
That is approximately 93% of their entire gross domestic product. And the annual interest bill alone, just to service that debt, not pay it down, is approaching £111 billion.
Which goes back to that wild statistic we opened with. That interest payment is roughly 8% of total public spending.
Yeah.
It completely dwarfs what they spend on national defense. And there is no obvious mechanism for the chancellor to stop it from growing, right? Because you can't just tax your way out of a hole that deep without completely crushing the economy.
You can't. And historically, they haven't tried to, which, brings up the obvious counterpoint.
Wait, let me stop you there, because I know exactly what people are thinking right now.
Sure.
Governments have been drowning in debt for decades.
True.
Every time they get in trouble, central banks like the Federal Reserve or the Bank of England, they just step in, they lower interest rates, they print a bunch of money, buy the bonds, and patch the dam.
That's the standard playbook.
Right. We saw it in 2008. We saw it in 2020. So why is this specific moment any different? Like, why can't they just print their way out again?
That is the trillion-dollar question.
Literally.
Literally. The reason they can't is because the environment has fundamentally changed. Printing money to buy bonds, what they call quantitative easing.
Right. QE.
Yeah, QE.
Yeah.
It's a tool that only works in a deflationary environment.
Okay. Explain that.
2008, demand collapsed. People stopped buying things, so prices were falling. When you print money in that scenario, it just fills the hole.
Got it.
But today, we are facing structural, supply-driven inflation.
Because we literally don't have enough physical stuff to go around.
Exactly. Central banks are now completely handcuffed.
Wow.
If they print money to bail out the bond market today, they inject a massive amount of cash into an economy that is already struggling with high prices.
It makes inflation explode.
Exactly. And when inflation explodes, bond investors demand higher interest rates to compensate for the loss of purchasing power.
Oh, I see. Which makes the government's interest bill even higher.
Yes, which requires even more money printing. It is a mathematical doom loop.
That is terrifying.
The one policy tool that bailed out the financial system 6 times in the last 15 years is now, practically speaking, unusable.
Okay, so if the government dam is cracking and central banks can't reinforce it with printed money because it'll trigger hyperinflation, what gets flooded first downstream?
The water hits the shadow banking system.
The shadow banking system.
Yeah. Specifically, an area known as private credit. This is a $1.8 trillion industry that operates largely out of the public eye.
Okay, let's shine a massive spotlight on this because this is the hidden bomb that, nobody talks about at dinner parties. What actually is private credit?
So after the 2008 crash, regulators forced traditional banks to stop making super risky loans.
Right, they tighten the rules.
Exactly. But the demand for those loans didn't just disappear, it just moved into the shadows.
Into private credit.
Yes. Giant investment firms created these private credit funds. They pulled money from yield-starved investors and started lending directly to mid-market private companies. Think regional logistics firms, software startups, private equity roll-ups.
Okay, and on paper, I'm sure it looked great. Investors were getting high returns. But there is a massive, fundamental structural flaw built into this $1.8 trillion machine, isn't there? Like a liquidity mismatch.
A profound mismatch. These private credit funds promised their investors liquidity. They said, hey, if you need your money back, you can cash out at the end of the quarter.
Right.
But think about the underlying assets those funds actually own. They own complex, highly illiquid loans to private businesses.
Yeah, you can't just liquidate a regional car wash chain or like a mid-sized manufacturing plant on a Friday afternoon to pay out an investor.
You absolutely cannot. And now that mismatch is being violently exposed. Giants of the industry firms like Blackstone, BlackRock, Morgan Stanley,
The biggest names.
the biggest, they are gating their redemptions, meaning investors are showing up asking for their money back, and the funds are locking the doors.
Wow.
They are capping payouts at maybe 5% or in some cases offering IOUs instead of cash.
That's insane.
And to make matters worse, Christian Strack, the president of PIMMCO, is one of the world's largest bond managers.
Right.
He has publicly stated they won't buy these private credit loans from these struggling funds at any price.
At any price. So we aren't just looking at a temporary cash flow problem here. This is a solvency crisis wearing a Halloween costume of a liquidity crisis.
That's a great way to put it.
I want to use an analogy here for you listening. It's like a crowded theater where everyone bought a premium ticket that promised a VIP private exit door.
Right.
But when someone in the back yells fire and everyone rushes for that VIP exit, they realize the door isn't just locked, it's welded shut.
And the terrifying part is watching everyone realize the doors are welded shut at the exact same time.
Exactly. But let's bring this down to ground level. If I'm listening to this right now, I might be thinking, okay, a bunch of Wall Street billionaires can't get their money out of a shadow banking fund. Tough luck.
Right. Who cares?
Exactly. How does a private credit freeze actually hit the ordinary person driving to work today?
It hits you through what we call the corporate transmission mechanism. Remember, traditional U.S. banks have hundreds of billions of dollars tied up in lines of credit to these private credit providers.
Okay.
When the private credit market freezes, panic spreads. Credit across the entire economy tightens up.
It's a domino effect.
Exactly. That mid-sized manufacturing plant in your town relies on those loans to operate. Suddenly their debt comes due, and the private credit market says, sorry, we can't refinance you.
And when a company can't refinance, they don't just sit there and shrug. They go into immediate survival mode.
Right.
They halt their expansions, supply chains get disrupted, and most importantly, they slash their headcount.
Yes.
When Wall Street gates those redemptions, it translates directly into a 20% layoff at the company your neighbor works for. That is how shadow banking distress becomes your family's economic distress.
Absolutely. But this brings us to a crucial pivot point in the deep dive.
Okay.
We established earlier that central banks can't bail out this shadow banking crisis because their hands are tied by structural inflation.
Right, the doom loop.
So we have to ask, what is the storm dropping the rain? What is the spark forcing that inflation up and keeping the central banks handcuffed?
It's the physical world breaking down. We are looking at a severe physical energy shock.
Yeah. And looking purely at the raw, impartial geopolitical data from the sources, the situation in the Middle East is cascading.
Tell us about the Strait of Hormuz.
Right. So the ongoing conflict involving Iran has effectively closed the Strait of Hormuz to commercial tanker traffic.
Which is massive.
It's the choke point for roughly 20% of global oil and liquefied natural gas, or LNG. But the far more critical issue is what happened in Qatar.
Yes, Ras Laffan.
The Ras Laffan facility, the world's largest LNG plant, sustained serious damage in recent strikes.
We really need to pause on the scale of Ras Laffan to understand why this matters.
Please do.
This isn't just a generic factory. This facility is 3 times the size of Paris.
Which is hard to even visualize.
Right. It cost hundreds of billions of dollars to build, and it took 3 decades to put together.
And right now, the CEO of Qatar Energy has declared force majeure, which is a legal clause that frees them from their contracts due to an unavoidable catastrophe.
So it's totally offline.
Overnight, 17% of total global LNG capacity was taken offline.
Wow.
And this is not a software glitch you can patch over the weekend. The engineering estimates suggest repairs will take 3 to 5 years.
3 to 5 years.
And in the meantime, Europe's gas storage is sitting at critically low levels.
I really want to emphasize how invisible this entire supply chain is to the average person standing in the produce aisle at the grocery store.
Definitely.
Because, we tend to think of an energy crisis purely as the price of petrol going up at the pump.
Or your heating bill.
Right. But natural gas isn't just for heating or driving. Natural gas is the core ingredient required to make nitrogen fertilizer, specifically urea.
Yes.
The data shows that roughly half of normal global urea exports were disrupted in just a 2-week period.
Because Iranian production of urea was knocked offline, and Qatar's LNG processing is disabled.
Right.
The chain reaction is brutal. The global food system runs on nitrogen fertilizer. Fertilizer runs on natural gas. Natural gas runs through the Persian Gulf.
It's a straight line. And this is the realization that should stop everyone in their tracks. This isn't a temporary dip on a stock market chart that magically fixes itself the second diplomats announce a ceasefire on television.
No, it's not.
This is massive physical thermodynamic infrastructure. It takes half a decade to rebuild, and until it's rebuilt, it directly dictates the price of food on your kitchen table.
Exactly.
That physical reality is the inflation that is keeping the central banks from printing money to save the bond market.
But the situation is even more complex.
Of course it is.
Because there is another massive force operating in the background. While the physical energy grid is breaking and corporate credit is freezing, we have an earthquake simultaneously fracturing the concrete of our dam.
And that is the exponential explosion of artificial intelligence.
Right.
Everyone is talking about AI right now, but almost nobody is connecting it to this macroeconomic and energy story.
They are completely inseparable. First, just look at the physical toll. AI is not just, magic code floating in the cloud. It requires staggering amounts of electricity.
Huge amounts.
The compute power being used to train frontier AI models is currently doubling every 6 months.
Every 6 months.
Yeah. Data center capital expenditure is running between $400 and $450 billion in 2026 alone.
Wow.
And projections have it hitting $1 trillion annually by 2028.
Which means all of these massive new AI data centers are actively competing for the exact same constrained, damaged energy grid that is already struggling to produce fertilizer and heat homes.
Exactly. That is the physical collision.
Yeah.
But the economic collision is just as severe.
Explain that.
Well, the standard comfortable narrative pushed by tech companies is that AI is just a really smart assistant.
Right. A tool.
It's a co-pilot that makes workers more productive, which should theoretically lower costs and help fix inflation.
Right, but I have to stop you there because if you actually look at the data, that narrative falls apart.
It does.
There's an organization called MT-Tier Model Evaluation and Threat Research.
Yeah, their work is fascinating.
It is. They don't test AI by having it take the bar exam or write poetry. They measure what is called the time horizon of AI.
Right.
Meaning, how long of a complex professional task can an AI agent complete autonomously without a human constantly holding its hand?
And what are the numbers?
Well, back in late 2022, when ChatGPT first launched, that horizon was about 30 seconds. By early 2026, frontier AI models can autonomously complete tasks that take human professionals over 14 hours.
And the terrifying metric is that this time horizon has been doubling every 7 months.
Yep.
And recently, that compression accelerated every 4 months. When an AI reaches a work month time horizon, it is no longer assisting with your job. It is executing your job.
It is substitution, plain and simple, not assistance.
Exactly.
And if we thread this back to that private credit bomb we discussed earlier, we are seeing JP Morgan literally block loans to software as a service or SaaS companies right now. Why?
Yeah.
Because a SaaS company that built a business model charging clients $50,000 a year for workflow automation software is suddenly competing with a $100 a month AI tool that does the exact same thing instantly.
Yeah, AI is permanently vaporizing their business models.
Instantly.
Which means those companies collapse and those private credit loans they took out are never getting repaid.
So the dam breaks.
Exactly. This is a textbook example of what historians call the tainter complexity mechanism.
Okay, what is that?
Joseph Tainter studied how civilizations collapse. He found that societies build incredibly complex systems to solve problems, but eventually, the sheer cost of maintaining that complexity becomes so high that the system implodes under its own weight.
Fascinating.
Our technological complexity is now dismantling our existing economic architecture. Just look at Meta. They recently announced plans for layoffs affecting 20% of their workforce.
1%.
They're using the very AI tools they helped pioneer to eliminate a fifth of their own employees.
And the churn of this displacement is absolutely brutal. The jobs being destroyed aren't manual labor, they are entry-level and managerial cognitive roles. The white-collar class.
Yeah.
It's hitting the exact same ordinary people who are already having their wallets drained by food and energy inflation.
This is the ultimate convergence. You have a massive deflationary technology AI permanently replacing human labor colliding head-on with an inflationary monetary system that is leaking value because of a physical energy crisis.
Wow. So, if you are an investor looking at this landscape, faced with breaking government bonds, a frozen shadow banking system, soaring energy prices, and AI vaporizing corporate business models, where do you put your money?
That's the question.
Right. Where is capital actually fleeing to survive this flood?
During these kinds of deep structural transitions, capital always seeks hard assets, assets that cannot be printed or expanded by decree.
Like gold.
Naturally, we're seeing a massive flight to gold. It recently surged past $4,500 an ounce. Central banks globally have been hoarding it at a pace we haven't seen since the Cold War.
Right.
It is the traditional multi-millennial hedge against currency debasement.
But there is a really critical vulnerability with gold that history warns us about.
Yes. The historical precedent is incredibly clear and quite ruthless.
Let's hear it.
When sovereign governments face extreme fiscal stress, they do not simply let their citizens opt out of the system. They often restrict or outright confiscate gold.
Wow.
It's physical, it's heavy, it's slow to move, and it's visible. The U.S. government famously confiscated privately held gold in 1933.
Under Executive Order 6102.
Exactly. And the British government maintained strict exchange controls on gold for 40 years. If the state needs it, they take it.
Which brings us to the digital alternative, the asset uniquely engineered for this exact moment, Bitcoin.
Currently trading around $70,400 in the 2026 data we're analyzing.
Right.
What's fascinating is how this is framed not just as a financial instrument, but as a thermodynamic proposition. Bitcoin solves the physical vulnerabilities of gold through pure mathematics.
It provides what is called unforgeable costliness. It takes immense real-world energy to mine a Bitcoin, proving its value, but storing it requires zero physical space.
None at all.
You have a 12-word private seed phrase that mathematically guarantees your ownership. It carries no weight. It can cross heavily militarized borders completely invisibly.
And if you hold those 12 words in self-custody, it simply cannot be physically seized by a desperate government.
It's unconfiscatable.
Right. And we're already seeing the geopolitical validation of this mechanism. When the U.S. government declared Bitcoin a strategic national asset in 2025, it triggered a sovereign scramble.
Of course it did.
When one major nation-state declares a fixed supply, mathematically scarce asset as a national reserve, every other nation is forced to start accumulating it simply through game theory.
They cannot afford to be left behind.
Exactly. Bitcoin operates entirely outside the failing institutional trust that underpins fiat money.
Okay, we've covered immense ground here. We've talked about failing bonds, energy choke points, AI job displacement, and the flight to hard assets.
A lot of heavy topics.
Yeah. So I want to ask the ultimate so what question for the person listening to this right now.
Okay.
Does all of this mean we are heading for like a cinematic overnight Weimar Republic style collapse? Are we going to be wheeling barrows of cash to the bakery to buy a single loaf of bread next week?
It is vital to understand what analysts call the honest projection.
Okay.
The answer to the wheelbarrow question is no. We are not looking at an apocalyptic Mad Max overnight collapse.
That's a relief.
Yeah, but what we're actually facing is a grinding, multi-year erosion of purchasing power.
It's a slow bleed, not a sudden explosion.
Exactly. Looks like your pension thinning out because it was mandatorily invested in those failing government bonds.
Ouch.
It looks like your wage is consistently falling 5 to 10% behind the real cost of living year after year.
Living standards just slowly degrade.
The middle class gets hollowed out. What is crucial to internalize is that during these major monetary transitions, wealth does not magically disappear from the earth.
Right, it goes somewhere.
It simply transfers. It transfers away from those holding paper, fiat, currency, and conventional financial assets straight into the hands of those holding hard, unforgeable assets.
Which brings us to the most urgent takeaway of this entire deep dive. There is a concept known as the pre-commitment principle.
Yes.
When governments face this level of extreme, inescapable fiscal pressure, when the debt is mathematically too high and the tax revenues are too low, historical patterns show they always, inevitably, run the exact same playbook.
Every time.
First, they roll out aggressive wealth taxes. Then comes financial repression, forcing institutions to buy their bad debt. And the final stage is always capital controls.
Capital controls are designed to trap your money inside the burning system so it can be taxed or inflated away to pay the government's debts.
Wow.
We are already seeing the early stages. The UK has raised capital gains taxes, expanded bulk data gathering by the Revenue and Customs departments,
Oh, yeah.
and is actively pushing pension consolidation to funnel private savings directly into government bonds.
And here is the kicker about capital controls. They do not come with a polite warning letter in the mail.
No, they don't.
They happen over a weekend. Look at Cyprus in 2013 or Greece in 2015. You go to sleep on a Friday night thinking your money is yours.
Right.
You wake up on Monday morning, open your banking app, and find a hard €60 a day withdrawal limit. The exits lock instantly.
That is the essence of the pre-commitment principle.
Right.
It means deciding right now what specific signals will prompt you to take action to protect yourself, rather than sitting around constantly waiting for just one more piece of confirming information.
Because in financial history, absolute certainty only arrives after the doors have already been welded shut.
Exactly.
So are you just going to nod along to this deep dive, treating it as an interesting intellectual exercise in analytical space? Or are you going to move into operational space and actually prepare?
The synthesis of all these converging forces is grim. There's no sugarcoating it.
No.
But it is an essential reality to face. The institutional scaffolding we all grew up trusting is buckling. The fiat ship is taking on water.
And the band is still playing on the deck.
Yeah.
You have a choice right now. You can stay below deck, rearranging the deck chairs and hoping the water stops rising, or you can get in the lifeboat while there are still seats available.
Get in the lifeboat.
Do not wait for the politicians or the central bank engineers to officially agree to sound the alarm. They won't sound it until it's too late.
And if there's one final provocative thought to leave you with, it's about what happens after you secure your assets.
Okay.
The people who survived historical transitions of this magnitude intact weren't just the ones who bought the right gold or held the right Bitcoin.
Who are they?
They are the ones who built deep, resilient communities. When the state's infrastructure bends under its own weight, community becomes your actual infrastructure.
Wow.
Who are your neighbors? What skills do you share? True wealth in a transition isn't just a 12-word seed phrase. It's the network of trust you build outside the failing system.
So as the floodwaters finally rise against that ultimate dam, there is only one word left to say: row.